Hello, I'm Bob Power with OTC Markets Group. Welcome to our OTCQX educational webinar on the growth of exchange-traded funds with our guest speakers, Michael Rice, Managing Director, and Chris Romano, Director of Research at ETF Global. Before we get started with the webinar, there are a few housekeeping items. We would like to welcome all attendees to the webinar and thanks for joining us. All attendees to the webinar phones will be on mute. Any questions that you have can be entered in the chat box located on the bottom of the screen. The questions will be addressed at the end of the presentation. And now I'd like to welcome Mike Rice and Chris Romano of ETF Global. Welcome, Mike and Chris, and thanks for joining us as our featured speakers.
Thanks, Bob, and we appreciate you having us. Good day, everyone. It's Michael Rice here, joined by our Director of Research, Chris Romano, who's actually dialing in from Austin, Texas at an institutional conference, so we appreciate that, Chris. In the next 20 or 25 minutes, our goal is to really share with you the insight and education that we've gleaned in working with various investor relations officers regarding the ETF ownership of their company stock, and hopefully provide a little insight to help you all face off with your institutional ownership, those that you work with internally, whether it's the C-suite or business owners. So with that, let me tell you a little bit about our company. We're a U.S.-based company who services companies and clients all over the world, which I'll talk about in a second. And we are a leading provider of data, research, solutions, and analytics on exchange-traded products. Now, during the course of this discussion, which, Bob, please, any questions along the way that you see from the audience, please let me know. We're happy to make this conversational as we go through.
Thanks, Mike.
But the term ETP and ETF we'll use interchangeably. For those that may or may not be familiar, ETP is exchange-traded product, which is inclusive of ETFs, so exchange-traded funds, ETNs, exchange-traded notes, ETCs, exchange-traded commodities, and then other ETCs, which are exchange-traded currencies. So we'll use those interchangeably today, but suffice to say that at ETF Global, we are focused exclusively on ETPs, and we service an eclectic client segment that includes institutional asset owners and managers, the middle markets and capital markets, ranging from trading desks to algo traders and liquidity providers. And then we also service the sell side. And as you can imagine, each of those client segments utilizes our data or research or support applications and analytics very differently. Also, a very quick growing part of our business is working with companies like yours out there that find themselves more actively and more comprehensively owned by exchange-traded products than ever before. So today we hope to shed a little light on that dynamic and talk a little bit about where ETFs have been, where they are today, and most importantly, where they're going, and hopefully give you a bit of a strategic advantage in your understanding as to how to utilize this information education in your daily activities. So with that, I mentioned that Chris Romano was on the phone with us. Chris, how are you?
Good. How are you doing?
Doing well. We appreciate you joining us. And just a little background on Chris. Chris has been with the firm since inception, which is about 6 years now. And he is truly the designer and architect of our two multi-factor models, which we use to rate and rank various ETFs out there. And he's also the driving force behind our data schema, which is the most comprehensive out there specifically for ETFs. So with that, Chris, I was hoping we could take the next slide and talk a little bit about the opportunity that exists in ETFs, certainly for some that deploy them, whether in their portfolios or other investment or trading activities, and a bit of the necessity that comes along with something that now represents at times between a quarter and a third of the average daily trading volume on some of the largest exchanges, and a very quick growing piece of AUM out there. So if you could Give us a little backdrop.
Yeah, definitely, and thanks, Mike. So the ETF world, ETP world, currently sits a little over $4 trillion in assets, and they've been growing at a compounded growth rate of around 30% per year since when they essentially launched back in 1993 when the first ETF launched. And they have obviously grown from zero to a pretty significant force in the marketplace in terms of both AUM and trading volume, as Mike alluded to. And we are seeing a huge flow of assets away from active managed products like mutual funds into these passive and quasi-passive products within the ETF world. So they are gathering a lot of assets, and it's important to understand how these products are influencing, if they are influencing the underlying components or stocks within the products. And as we talk to a lot of our clients, whether they're large institutional asset managers, asset owners, trading shops, they look at ETFs in various different ways, both at the ETF level and at the underlying constituent level, and how they pair different trades together, access the underlying securities to trade and build these ETF products. So for an IRO, it's really important to understand how your company fits in with the products, how these product manufacturers are viewing your companies, how the index providers are all kind of interrelated in looking at the various companies, because they potentially could influence volatility and correlations between your company and similar companies to yours.
Now, Chris, a quick question. As you mentioned, there is a ongoing and very well-documented debate between active versus passive investing. But the interesting dynamic that exists within ETFs is that twofold. One is that not all ETFs are passive, obviously, and we often discuss with IROs actively traded money managers who use what I would call beta products, which are, let's say, ETFs that are passive, but they're being used within an active portfolio. And then I think the more interesting point is that potentially the fastest growing component of ETFs forecasted is the actively managed ETF. So if you could, just a minute on each.
Yeah, so it's not as simple as saying passive versus active in the ETF world. Currently, in the U.S., there's a little over 2,000 products. About 10% of all products are actively managed, and this is purely active managed products where they're not tied to a specific index and ran as an active portfolio. But one of the biggest growth segments is these, what I call kind of quasi-active, and you'll see the term smart beta, strategic beta, which are really systematic, rules-based products that are indexed, but are really very similar to an active strategy, where an active manager has taken their investment process, built a rules base around it, and created an index. And these have higher turnover ratios generally within the portfolios, very similar to an active manager. So it's really important to understand the difference between the kind of initial products that were cap weighted, cheap beta, versus a lot of the new products that are coming out that are these rules and systematic based strategies and funds.
Guys, this is Bob. I have a quick question. So reasons for the explosive growth in ETFs, is it because of the inherent liquidity, the tradability of the products? Is that part of it, or, what's your observations there?
It's all of the above. ETFs were originally created for institutional investors, but retail and RIAs were the first to really take hold of it and run with them. In the last few years, institutional investors are driving a lot of the growth, and they're flocking towards ETFs for the tradability, the cheap beta, and it's really they're using them as building blocks within their larger portfolios. So the transparency, the ease of trading, the ease of getting broad or specific exposure into one trade and not having to trade, 50, 60, 70 different securities. They can trade one in a very quick and cheap fashion.
Mm-hmm. And Chris, I'll just add the transparency, right? The ability to know what's in that portfolio on a daily basis.
Yeah, definitely.
So it's also, Bob, a good segue into, for the audience, just describing some of the geographic growth and landscape that's out there. So if we could, on the next slide, and Chris, please add where you see fit. This is it's a bit of a busy slide, so we apologize, but a lot going on within the ETF world, in particular for growth. But you can see that for the last, let's call it 14 years from 2003, effectively in the U.S., it's been a mountain chart. As Chris has alluded, several thousand products now, a couple thousand products in the U.S. With a 10-year compound average growth rate of 19.4% and accelerating, right? So if you look at the year-to-date growth, you're looking at 24.2%. So, as we like to say, it seems that ETFs here in the U.S. are getting broader and deeper as we go forward. From our viewpoint, we're also seeing some very interesting dynamics about who's starting to embrace ETFs. I can tell you that some of our largest clients are the biggest quant funds in the world, general accounts of insurance companies, public and private pensions, and we hear direct feedback from them that while 3 or 4 years ago they intermittently may have touched ETFs, now they find ETFs to be an integral part of their strategy for all the attributes that Chris alluded to, whether it's tradability, transparency, tax advantage, etc. So with that, for the next slide, maybe a little easier to understand here with some bullet points, but effectively U.S. assets in ETFs have increased, as I mentioned, over 24% in the first 9 months of 2017. Chris alluded earlier to a $4 trillion number globally. The preponderance of that is in U.S.-listed ETFs. And keep in mind, if an ETF is listed, obviously, in the U.S., it can hold all companies like yours that may be publicly traded elsewhere, which we'll talk about in a second. And that number is about 2,035 ETFs from 117 providers on 4 different exchanges here. I can tell you that 6 years ago when ETF Global began, there were 40 providers. We know this because we actually source our data directly from the provider, the ETF issuer, their custodian, et cetera. So that has expanded tremendously. And I think more impressively, we've seen 20 consecutive months of net inflows. If we had more time, we could talk about where those inflows are coming from and debate whether they're coming from open-end mutual funds or other products. But within the confines of this framework, suffice it to say that ETFs continue to grow very strongly here in the U.S. If we turn to the next slide, on the European front, I can tell you, and I know that many of you are domiciled and have activities there, a very similar and maybe even stronger story. So while there are less assets in Europe today, there are far more products, which we'll get to in a second. And as we look at the compound average growth rate, similarly, the recent growth and acceleration is even stronger. Our corporate position and forecast going forward is that we think the greatest acceleration growth will come from European products and even Asian products. And candidly, I know many of you have activities or domicile potentially in Asia. The story there is almost identical to that from the European, from the U.S. story. A lot more products, a small amount of assets, and a very high growth rate. So if we could go to the next slide. European listed assets have increased 31% versus what you saw previously in the U.S., which was 24%, significant delta there on the upside. Almost $1 billion, roughly $750 million as of the end of September. As I mentioned, this is should be 7,200 ETFs. Sorry for the misprint there, but from 60 providers on 27 exchanges in 21 countries. So when you look at the landscape in Europe, obviously far more diverse, obviously cuts across geographic regions, which is not the case in the U.S., and very persistent inflows, 36 consecutive months of inflows. So as we look at the European landscape, I can tell you that we began our company in covering U.S. listed ETFs. We have been absolutely drawn to cover first the Canadian listed products for data and research, which we're in the process of completing by the end of the year. And we're already underway to cover the European listed products, of which we've got about 75 to 80% of the data in place going forward. And it's really out of demand, Bob.
Yeah.
We've seen this. You can see the growth rates. The numbers are the numbers. And as you look at the future, we think this is a persistent trend that's backed up by our discussions with both European and Asian investors and ETF providers.
So a question would be, in the U.S. In particular, the bull market, the growth of the market itself. And in Europe to some degree as well, do you attribute the growth in ETFs to that? And what happens if you see some kind of a correction? What happens to the ETF world?
Well, two different questions. We see a lot of the similar things that draw investors in Europe and Asia as they do in the U.S. Mm-hmm. Things that Chris mentioned that we'll talk about here in a second as well. Ease of access. One product allowing an investor to gain access in an incredible number of sectors, geographic regions, et cetera. And there are a lot of debates going on about a correction in beta products and index products. I will tell you that I don't consider myself a market pundit, but I think as we look at it, corrections are part of market cycles. I don't feel that personally that exchange traded products are going to exacerbate that, but maybe even on the flip side, provide liquidity where that may not exist in some of these more opaque or different far reaches of these equities. So we think that more liquidity is good, and we think ETFs provide that. With that, if we just want to move on to the next slide, and this is just, again, not knowing the familiarity with each of our participants here, but we've covered a bit of this already with Chris. What are ETPs, exchange traded products, and ETFs? Effectively, these are portfolios of companies, often predicated on a passive index or a smart beta index, which would kind of be the middle part, and then or an actively traded portfolio, which would not be an index, but rather directed by a portfolio manager, that trade on an exchange with tradability during the day, unlike an open-end mutual fund, which would price at the end of the evening, and depending on your markets, are required to provide transparency as to what's held either daily or in some other markets less frequent than daily. So how do they work? As I mentioned, they're listed on exchange. They're issued by asset management firms, many names that the big three here, obviously in the U.S. are Vanguard, State Street, and BlackRock. Also very strong in the European markets with other more local providers that domiciled anywhere from France and Switzerland, etc. They are treated like a portfolio. However, some of the trading strategies, some of the investment strategies use ETFs, I can tell you, to isolate certain parts of an ETF, where if an ETF owns, let's say, 200 positions, a particular investor may feel more strongly about 20 or 30 or 50 and use some derivatives or a certain strategy to emphasize those. And then finally, I'll say who owns ETFs, and this is a very important dynamic that we see unraveling. As I mentioned, I think ETFs, since their inception in 1993, were looked at a little bit like a retail product, the retail investor, because they were new, they were something that provided an alternative to open-end mutual funds. But as I mentioned earlier, we are seeing more and more significant institutional investors utilize ETFs both for trading and for long-term investment purposes. And these are public and private pension plans. These are endowments, foundations, family offices, have come in a big way. And as I mentioned, Chris is currently at a conference. It's exactly what he's addressing there, is helping institutional investors of the profiles that I just described understand exchange traded funds, every bullet point on this list. Just a little bit about our process. We run a quant-based research model, Fama French disciplined. This is something that just want to give you a little insight to, so that you'll understand part of the education and insight that we provide investor relations folks in how to compare one ETF to another. But suffice it to say that we gather our data from hundreds of ETF issuers, their custodians, their administrators, and their distributors. We run it through a series of quant-based models that have 4 primary drivers: behavioral finance, that encompasses both technical analysis and sentiment; fundamental analysis; global themes, where we address 250 countries around the world for a variety of different inputs, ranging from cost of capital to unemployment, et cetera; and then the quality of the issuer and the quality of the underlying product itself. So I mentioned this to you only if we go to the next slide, please. We generate for our users, and this is across the board, a review of this on a daily basis. So each of these two models update daily. It's very much an investment view versus a trading view, although we have plenty of trading firms that are creative in how they use it. Next slide, please. That provides both an overall quant look as well as a risk rating that we assign a certain number of red diamonds to. So with that, just as backdrop, I wanted to spend a few minutes here looking at exactly what we address with IROs and why we think it's so important, for them to understand ETFs. So next slide, please. Here, we provide to most investor relations groups what we call our ETF exposure report analysis. And in a nutshell, what this does is takes your publicly traded company and aggregates its exposure in all the ETPs that exist out there. Let's, for this purpose, just talk about U.S. listed ETPs, which I mentioned. There are a couple thousand and about $3 trillion in assets. So we then take that information, and I'll show you a live example in a second. We break it down to provide you a sector comparison to show you how you stack up in its ownership and exposure versus others in your sector. We take from our IRO clients a smaller finite peer group, where they may have 3 to 5 peers that want to see how much is owned by ETFs for their peer group. And then we provide, most of all, a detailed profile of the ETFs that own your company. So you know exactly who they are, what else is in those ETFs, what their exposure is on a variety of fronts. And we do that both long, short, and aggregate net for you. So with that, if we could go to that first window, please. This is, we're going to toggle to a live look at Apple. Again, this is just for argument's sake. So this is Apple, and working top down, just a little information on Apple's publicly traded stock. What we want to hone in on is the ETF exposure summary. So if you look at this, what you're seeing is that the total exposure for Apple within all U.S. listed ETFs is $5.4 billion, which represents about 5% of the market cap. Long, short is less than $500 million, and nominally netted out, you obviously see 49. So I said 5.4. Sorry, I misspoke. My eyes are not what they were. It's 49 billion, and then the absolute is about 50.31. So what this is doing is this is running an algorithm to take inclusive of leverage, which is important for those that are familiar with some of these products. There are levered products, so we do take that into consideration. And below, you can see that we show every just page down a second. That's good. So if we'll show that there are, all the way at the bottom, there are 240 ETFs that own Apple. The first one, IYW, iShares U.S. Technology, U.S. listed in U.S. dollars, has an equity weight of 17.5%. So that means that 17.5% of that ETF is in Apple. I'm mentioning this because oftentimes, rather than buy the equity itself, institutional investors will buy an ETF to gain that much exposure because there are other positions in the ETF, let's say in this case technology, that they'd like exposure to. And then we show the leverage factor and the long, short, etc. So if you were to click on any of these positions, we would then provide you a detailed snapshot of that specific ETF. So if we go to the second window, please. This is just an example of iShares MSCI ACWI, the All World Country Index. And this is a very widely held global ETF. And just paging down slightly, you can see the two the risk rating and reward rating that I mentioned that emanate from our multi-factor models that I touched on earlier. A description of the ETF, the inception date, the expense ratio, the assets under management in the ETF, and its underlying index. Little trading data as to performance and some details, and then we get into really the exposure of the ETF. In other words, what aggregate exposure for geographic, currency, sector, industry group, industry exposure, and sub-industry comes along with buying that ETF that your company is held within. If you just page down, please, to the bottom. The holdings, so this, if your company, like in this case, Apple is in here, it's the #1 holding with a 2.04% weighting. Your company would be shown here in the holdings. If we just page down to the bottom, you can see that this is all sortable, and this is sorted by its weighting. There are 1,384 publicly traded companies held within this ETF. So obviously a very broad-based ETF, a very global ETF with the breakdown, as you can see. This is the tear sheet. This is our summary tear sheet. This is the kind of thing that we provide and you have full access to understand if you're asked a question on an investor call or at a conference about a certain ETF that may may hold your publicly traded stock. A quick go-to in addition to your legacy market surveillance, which probably doesn't have this kind of depth. If we go back to the presentation, please, and the next slide. Just want to spend a second as we're coming up on the end of our time. This is a sample of a peer group analysis report that, in addition to what we're showing you from the live site, we provide a monthly and/or quarterly snapshot of what your peer group analysis would look like. So effectively what we do is we take a wider swath that we can define a variety of ways, whether it's SIC codes or other peer group definitions, and we aggregate the companies and the number of ETFs that each has owning their respective equity. And we show you that top part of the report that I just illustrated, where we aggregate the nominal ETP exposure, long, short, net, and absolute. And then we average it, and we show, in this case, this is just sample data, but for Cohen and Steers, how they compare to the average of the peer group. On the next slide, we take from our clients a direct competitor comparison. In this case, let's say that we narrow this down to two particular competitors that they wanted to understand and they most closely see themselves competing with, and we would show the same type of thing on a far more narrow peer group comparison. Lastly, and this is something that we'll save the best for last, if you will. This digs into understanding the profile and the nuances of the ETPs and ETFs that own your company's stock. So Chris mentioned early on that we look at the world of ETFs in kind of three buckets. There's passive, there's active, and then in the middle, there's smart beta or strategic beta, as it's called. And so what we do is we break the world that owns your company stock into passive and non-passive. Passive being, in this case, again, sample data for XYZ. The ETF ownership, there are 41 that are passive, representing 36%, and non-passive at 72. Non-passive in this case would be both strategic beta and active. A lot of our clients want introductions and/or us to provide them detail on the active managers and what their strategies are within ETFs, so they can understand the background for ownership. We have conversations going on for some of the publicly traded companies and their IROs around activist investors, which there are a few ETFs, and looking at those activist ETFs as maybe a indication as to where interest may be, to give some of the companies a heads up that they may be in a peer group that an activist investor within the couple of activist ETFs have interest in. And then to the right here, pie chart on the bottom is simply a breakdown of the AUM between passive and non-passive. So suffice it to say that, you know, our feeling in working with a lot of investor relations departments is that, you know, we know that at times your roles can be a fire drill and, you know, running around trying to answer questions for institutional investors or those you support in the C-suite or business units. What we try to provide is education and insight so that, you know, where to get information on ETFs, you know, how to navigate that information, and when you come back with answers, that there's a value add and a granularity to what we're providing. So with that, I'll wrap it up, Bob. If there are any questions, I would love to take them.
Well, great. Thank you, Mike. Thanks for a great presentation. Yeah, we have one question here sent in. All ETFs are quant-driven. Is there a way that we as a company can engage ETFs since it's quant-driven? Is that correct? Or, you know, like they want to get involved in ETFs?
Yeah, it's a good question, and it's one we get a lot from, in particular, the institutional investment community at times. So because quants have gained so much publicity, I do think there's a misnomer out there that all ETFs are quant-driven, all investment practices are quant-driven. Certainly not. And there are plenty of fundamental research folks out there doing great work, and you know, would want to debate that. That said, engaging ETFs is what we're really talking about, right? Because ETFs, I think most would agree, are not going away. They've kind of crept up on IROs and some of the folks at the various companies in which they're held. And there are varying degrees of the ability to engage in ETF directly. So if an actively managed ETF was someone that wanted to, you know, be spoken with by a company that active manager held, that's no problem. You know, our information shows readily who's the portfolio manager, what the company is, et cetera. From a passive standpoint, passive index, there's not much you can do, whether it's generated by an MSCI or other big S&P, other big index providers out there. There's not a whole heck of a lot you can do there. But in the middle are smart beta indices, and they are generally quant-driven. It's kind of in between, right? So if your company meets certain attributes that are attracted to that algorithm, it's not always something you can manage. You know, you're not going to change from consumer goods to get into a tech smart beta ETF. So it's kind of somewhere in the middle.
Got it. Okay. Second question. Do you see a trend of IROs in their targeting approach, including ETFs in the process? So, you know, IROs spend a lot of time in focusing on who they want their investors to be versus their peers. Do you see that trend now where ETFs are part of the equation?
We certainly do. I can tell you that one of the fastest growing parts of our business is what we're talking about here. And I'd like to say it's, you know, attributable to what we do, but candidly, others, you know, provide information out there. And I think IROs are starting to find that their market surveillance package, which they've relied on in the past, doesn't really address the kind of qualitative and quantitative information and subject matter need for ETFs. So I would tell you that we're seeing that come up more and more from investor relations in a variety of different capacities, certainly for preparation for those that speak on investor calls, questions from conferences, and then just really from a ownership standpoint, trying to triangulate the ownership with the filings, let's say 13Fs, and who that is. And ETFs are starting to represent a larger portion of that. Also, there's a study that's it's available up online. We put a PDF up there. There's a study done by 3 professors that are renowned in the world of ETFs that demonstrate the more ETFs that own an underlying company's stock, the more volatility you see. So we do see examples where maybe an actively traded day in the market could be exacerbated by the number of ETFs that own a particular stock and that market movement.
Thank you. Well, I think those are all the questions we have. So, Mike and Chris, I wanted to thank you for an excellent presentation of ETF Global, and also I want to thank the listeners for listening in and remind you that a presentation is available in the handout section. We'll also be sending a recorded version of this presentation to all attendees. So, thanks to everyone, and have a great day.
Bob, thanks very much.
Very good. Thank you.